Welcome to Safe Simple Sound Podcast. I'm your host PK and this is episode 45. Today's topic is Finding Your Financial Advisor, a guide for different life stages. In our last episode, we explored the 7 steps of professional financial planning. Today, we will discuss how to find the right financial advisor for your specific life stage. Just as your personal and professional needs evolve over time, your financial advisory needs change as you progress through different phases of life. The first stage of life we want to talk about is the foundation builder. At this stage, you are likely focused on building both your career and financial foundation. Let's explore what young professionals typically need from their advisor. At this stage, you are juggling student loans while trying to build wealth. You need guidance on maximizing your early career compensation and setting up your first investment portfolio. Many clients also are planning for major milestones like marriage or buying their first home. When selecting an advisor for this life stage, prioritize on someone who speaks your language, both literally and technically. They should understand digital communication, student loan complexities, and the unique challenges of young professionals. Look for someone who emphasizes education and fits your schedule because you are likely balancing a demanding career with personal growth. Here is how to evaluate potential advisors. First, probe their student loan expertise. Do they understand various repayment strategies and their long term implications? Ask about their approach to analyzing job offers and compensation packages. Can they help evaluate stock options and benefits? Finally, discuss how they guide clients through major life transitions. Their answer will reveal their planning process and communication style. Here are my answers to these questions. As a CHFC, I help young professionals tackle student loans by analyzing income driven repayment options against their goals like home purchase or retirement savings. For compensation packages, I look beyond the base salary to evaluate benefits, stock options, and growth potential. When it comes to major transitions, I create detailed cash flow projections and help you build emergency funds while planning for your next big step. The next life stage I want to talk about is the family and career builder. During these years, your financial needs often become more complex as family and career responsibilities grow. You are balancing career growth with family needs, and that requires sophisticated tax planning and investment strategies. College savings compete with retirement goals, while insurance and estate planning become crucial for protecting your growing wealth. This stage demands advanced expertise. Look for strong credentials and a comprehensive planning approach. Your ideal advisor should demonstrate deep tax planning knowledge and maintain a strong network of other professionals. They need to understand both education funding strategies and career advancement opportunities. Focus your evaluation on three key areas: their tax optimization strategies, their approach to balancing competing goals like college and retirement, and their professional network. Their answers should demonstrate both technical expertise and an understanding of your complex life stage. Here are my answers to these questions. My CHFC training helps me identify tax efficient investment strategies and timing of major financial decisions. For the college versus retirement balance, I help you prioritize goals and explore options like 529 plans while ensuring retirement savings stay on track. I regularly coordinate with CPAs and attorneys, sharing my analysis of your financial situation to ensure all professionals are aligned with your goals. The next stage I want to discuss today is the wealth optimizer. At this stage, your financial situation often requires more sophisticated strategy and integration. As you enter your peak wealth building years, your planning needs become more sophisticated. You are focused on optimizing retirement timing, implementing estate planning strategies, and preparing for potential career transitions. Healthcare planning and multi generational wealth transfer strategies take center stage. At this stage, experience matters more than ever. Your advisor should demonstrate extensive knowledge of retirement transition planning and estate strategies. Look for someone comfortable with sophisticated investment management and multi generation planning process. When interviewing advisors, dig into the retirement planning process. How do they optimize timing and social security strategies? Explore their estate planning expertise and approach to healthcare cost planning. Their answers should reflect both technical depth and practical experience, guiding clients through these transitions. Here are my answers to these questions. Using my CHFC expertise, I analyze various retirement scenarios considering your income needs, investment returns, and social security timing. For estate planning, I help identify efficient wealth transfer strategies while maintaining control of assets during your lifetime. Healthcare planning involves estimating future medical costs, evaluating long term care options, and incorporating those expenses into your retirement income strategy. Regardless of your age, certain factors remain crucial when selecting an advisor. Let's discuss how your advisor should embody our core secured principles. A strong advisor empowers you to take control rather than creating dependency. They should demonstrate mastery of fundamentals like cash flow before jumping into complex strategies. Look for someone who balances growth opportunities with proper risk management. They shouldn't just focus on returns. Their communication style should help you truly understand your choices, not just present options. The advisor should show how they adapt plans as circumstances change, and importantly, help you think beyond your own needs to building lasting family wealth. When evaluating professional standards, start with the non negotiables. The advisor's fee structure should be crystal clear. No hidden costs or surprises. Look beyond basic credentials to their commitment to ongoing education. Their communication system should be consistent and reliable, using modern technology while maintaining strong security. Finally, they should have a documented, repeatable planning process they can clearly explain to you. Having spent 20 years as a software engineer before becoming a financial advisor, I have personally experienced the financial journey through each of these life stages. My transition from tech to finance has given me a unique perspective on the challenges and opportunities professionals face at different points in their career. While my CHFC designation provides the technical expertise to serve these groups, I recognize that finding the right advisor is more than just credentials. Let's talk about bringing all these criteria together in your selection process. Beyond checking credentials, really assess how the advisor communicates. Do they speak in jargon or explain things clearly? Review their planning process. Is it systematic or ad hoc? Get absolute clarity on how they charge for services. Evaluate their technology. Will it make working together efficient? Most importantly, ensure there is personal compatibility. You will be sharing sensitive information and working together for years. So, trust and rapport are essential. The right advisor combines technical expertise with a genuine understanding of your goals and values. You can schedule a consultation with me to discuss your specific needs, but we are not done yet. Now it's over to my AI co host Alex, who will do a deep dive into these topics with some real life scenarios.
Hey everyone, this is Alex. Now we're diving into the crucial topic of finding the right financial advisor for your specific needs. And we're basing our discussion on our helpful article titled Finding Your Financial Advisor, a guide for different life stages. This guide emphasizes how our financial advisory needs change as we journey through different phases of life, just like our personal and professional needs do. Two key takeaways really resonated with me. First, the emphasis on aligning your advisor's expertise with your current life stage. Are you focused on building a foundation, growing your family and career, or optimizing your wealth? Each stage has unique challenges and opportunities. The second takeaway is the importance of the secured philosophy, which, as you know, is central to everything we do here at Safe Simple Sound. This article really emphasizes how a strong advisor embodies these core principles, empowering you to take control, mastering the fundamentals, balancing growth with risk management, and planning for a lasting legacy. So, how will we navigate this today? We'll be exploring three key life stages, each with its own set of financial considerations. First, we'll focus on the foundation builder phase, typically ages 25 to 34, where we'll look at navigating student loan debt while investing and decoding job offers with stock options. Then we'll move on to the family and career builder stage, ages 35 to 44, and discuss the challenges of balancing college savings with retirement and optimizing your taxes as your family grows. Finally, we'll explore the wealth optimizer stage, ages 45 to 54, where retirement planning, healthcare costs, and estate planning take center stage. We'll also touch on choosing the right advisor for any stage by focusing on secured principles and understanding professional standards, ensuring your advisor is truly putting your ding interests first. Get ready for an informative episode packed with practical advice to help you find the perfect financial partner for your journey. Let's dive in. Today's first scenario focuses on a recent graduate with a hefty amount of student loan debt. They're eager to start building wealth through investing, but unsure how to balance paying down that debt with the desire to grow their money. Taylor, I imagine this resonates with a lot of people in their 20s and 30s. What are your initial thoughts?
Absolutely, Alex. I know so many people feeling this exact pressure. It feels like a catch-22. You know you should be investing early to take advantage of compounding interest, but that mountain of student loan debt looms large. It's tough to know where to prioritize.
Precisely. So let's get to the heart of it with a couple of key questions. Sam, first, how can a financial advisor help someone in this situation prioritize between aggressively paying down their student loan debt and starting an investment portfolio?
A good advisor starts by understanding the individual's entire financial picture, their income, expenses, debt load, risk tolerance, and long-term goals. Then they analyze the interest rates on the loans. High-interest debt, like credit cards, usually takes priority. Student loans can be a bit more nuanced. For example, if the interest rate on the loan is relatively low, say 4%, and the expected return on a diversified investment portfolio is potentially higher, it might make sense to allocate some funds towards investing while still making consistent loan payments.
So if I understand correctly, it's not always a black and white pay off all debt before investing situation.
Exactly. It's about finding the optimal balance.
So, the money you're using to pay down debt could potentially be earning you a return in the market.
Right, that makes sense. But what about the psychological benefit of being debt-free? I know for some people, that peace of mind is priceless.
Absolutely, Taylor, that's a valid point. A good advisor will also consider the individual's emotional comfort level with debt. If the debt is causing significant stress, it might be worth prioritizing repayment, even if it means slightly lower potential investment returns. It's about finding a strategy that aligns with both financial and emotional well-being.
That leads us nicely into our second question. Sam, what are the potential long-term implications of choosing different student loan repayment strategies? Our reference article mentioned income-driven repayment options. Can you elaborate on those?
Sure. Income-driven repayment plans base your monthly payments on a percentage of your discretionary income. These plans can be helpful for recent graduates with lower starting salaries. However, it's crucial to understand the long-term implications. Because payments are lower, you'll likely accrue more interest over the life of the loan.
So, lower monthly payments now could mean paying more in the long run.
Potentially, yes. But there are scenarios where income-driven repayment makes sense, particularly if it allows you to start investing and potentially earn a higher return than the interest accruing on your loans. An advisor can help you navigate these complexities.
Excellent points, Sam. So to recap, balancing student loan repayment and investing is a nuanced decision. The best approach depends on individual circumstances, risk tolerance, and long-term goals. It's not a one-size-fits-all answer, which is why seeking professional advice can be so valuable. In the meantime, listeners, if you're grappling with student loan debt and wondering how to start investing, take some time to evaluate your repayment options. Consider talking to a qualified financial advisor who can help you create a balanced plan that aligns with your unique situation. So, Taylor, we just explored how a financial advisor can help navigate the often tricky balance between tackling student loans and starting an investment portfolio. But what happens when you land that dream job and the compensation package is more than just a simple salary number? That's what we're diving into now, decoding a job offer with stock options and benefits. Imagine you're a young professional. You've nailed the interview process and you're staring at a job offer. It looks great, but the compensation section includes things like stock options, a 401k match, and various health insurance plans. Suddenly, figuring out the real value feels like trying to solve a complex equation. This is where a good financial advisor can be incredibly valuable. Taylor, in this situation, What would be your initial thoughts and questions?
Definitely exciting, but also a little overwhelming. My first question would be, like you hinted at, how can an advisor help analyze the total value of a compensation package beyond just that base salary number? It's clear there's more to it, but I wouldn't know where to begin dissecting it all. And then, connected to that, what are the key things to even consider when looking at stock options and all those different benefits? Health insurance alone can be a maze.
Absolutely, Taylor. Sam, could you shed some light on these questions? How does a financial advisor approach this kind of compensation package analysis?
A good advisor starts by looking at the whole picture. The base salary is just one piece. We delve into the details of the benefits package. For example, with health insurance, we'd look at premiums, deductibles, copays, and out-of-pocket maximums to estimate the potential annual cost for you. Then we compare that with other available plans, factoring in your health and anticipated needs. This helps quantify the value of the healthcare benefit.
So it's about assigning a dollar value to these often overlooked parts of the package. That makes sense. But what about those stock options? They seem so complicated.
Let's start with a simple example. Imagine the company offers you 100 stock options at a strike price of $50. This means you have the option to buy 100 shares of company stock at $50 each, regardless of the market price, at some point in the future. If the stock price rises to, say, $75, your options are worth $25 each, the $75 market price minus $50 strike price, a potential $2,500 gain.
It's like getting a coupon for future stock purchases, but the discount gets better if the company does well, right?
Exactly. Now, a more complex scenario includes vesting schedules. Your options might vest over 4 years, meaning you earn the right to 25 options each year. This encourages employee retention.
Doesn't vesting encourage you to stay with the company and benefit from its potential growth over time?
Precisely. And a counterexample would be if the stock price stays below $50. In that case, the options are worthless, but you haven't lost any of your own money, just the potential gain.
So, Taylor, do you see how understanding these seemingly complex elements can help you assess the true value of a job offer?
Yes, absolutely. If I understand correctly, an advisor helps quantify the value of benefits like health insurance and helps decode potentially confusing things like stock options, allowing me to compare offers apples to apples, even if they're structured differently.
Exactly. Sam, anything else young professionals should be aware of in these scenarios?
Yes, don't forget the 401k match. It's essentially free money. If the company matches 50% of your contributions up to 6% of your salary and you contribute 6%, they're adding 3% to your retirement savings. Factor that into the total compensation value.
So, the key takeaway here is that a job offer is more than just the salary. Benefits, stock options, and retirement plans are all crucial pieces of the puzzle. Taylor, any final thoughts?
I think this highlights the importance of seeking professional advice when evaluating job offers. It can be hard to see the full financial picture on your own, especially early in your career.
Absolutely. Don't just focus on the base salary. Research the value of benefits and seek expert advice to understand the full compensation picture. This will empower you to make informed decisions that set you up for long-term financial success. So, Taylor, we just finished talking about navigating student loans and job offers with stock options, very relevant for our younger listeners. But as we move into the next phase of life, things get even more complex, right? We're now stepping into the world of the family and career builder, those between 35 and 44, where balancing family needs with career aspirations takes center stage. Imagine this. You're in your late 30s, you've got a growing family, and you're starting to think seriously about your children's future education. College seems like a distant horizon, but it also feels like it's rapidly approaching. Simultaneously, retirement, while even further away, is becoming more real. How do you balance saving for both without sacrificing one for the other? That's what we're tackling today. The delicate balancing act of college savings and retirement planning. Sam, many of our listeners in this age bracket are probably wondering, how can a financial advisor help create a plan that balances both short-term education expenses like college and long-term retirement savings?
It's a common concern, Alex, and a crucial one to address proactively. A good advisor acts as a financial architect, designing a personalized blueprint that integrates both goals. They'll start by assessing your current financial situation, income, expenses, existing savings, and projecting future needs for both college and retirement. This involves understanding the projected costs of college, your desired retirement lifestyle, and the time horizon for each.
So if I understand correctly, they're not just creating two separate plans, but weaving them together?
Exactly. It's about optimizing your resources to fund both goals effectively. This might involve adjusting your budget to find additional savings, exploring different investment strategies with varying levels of risk, and choosing the right savings vehicles for each goal.
That brings us to our second question. What are the different college savings vehicles available, and how can they be integrated into a comprehensive financial plan?
The most common vehicle is a 529 plan. It offers tax-advantaged savings and investment growth specifically for qualified education expenses. Another option is a Coverdell Education Savings Account, which also provides tax benefits but has lower contribution limits. Then there are custodial accounts, which offer more investment flexibility but have different tax implications. And finally, there is an advanced option of using whole life insurance to plan for college. An advisor can help you navigate these choices based on your individual circumstances.
This reminds me of what we discussed about tax-advantaged accounts in a previous episode. The benefits really compound over time, don't they? But what if someone is really behind on retirement savings? Should they prioritize retirement over college?
It's a tough call, and there's no one-size-fits-all answer. However, a common piece of advice is to prioritize retirement. You can borrow for college, but you can't borrow for retirement. A good advisor will help you strike a balance, perhaps by contributing enough to retirement to maximize employer matching contributions and then allocating additional savings to college.
That's a great point, Sam. It's about finding that sweet spot where both goals are moving forward, even if it's not at the same pace. So to recap, balancing college savings and retirement planning requires a holistic approach. It's not an either-or scenario. Work with a financial advisor to create a personalized plan that considers your specific circumstances, utilizes appropriate savings vehicles, and optimizes your resources for both short-term and long-term goals. Prioritizing retirement while still contributing to college savings is often a good strategy. Don't wait. The sooner you start planning, the better positioned you'll be to achieve both your college and retirement dreams. Next scenario focuses on a family with a growing income who needs guidance on minimizing their tax burden while maximizing their investment returns. Let's dive into tax optimization for growing families. So, Sam and Taylor, two big questions come to mind as families grow and incomes rise. First, what tax-efficient investment strategies are suitable for families with children? And secondly, how can a financial advisor help optimize tax planning while considering other financial goals, like college savings or that dream vacation home?
Great questions, Alex. For families with children, tax-advantaged accounts are crucial. A simple starting point is the 529 plan, specifically designed for education expenses. Contributions aren't deductible at the federal level, but the growth is tax-free when used for qualified education expenses. Many states also offer tax deductions or credits for 529 contributions. A more advanced option is to use whole life insurance. A competent advisor can explain the full spectrum of options available.
Wow, so many options. Let's go with 529 plan option for now to keep it simple. So does prioritizing 529 contributions mean sacrificing retirement savings?
Not necessarily. A good advisor can help you find a balance. For example, they might suggest maximizing your 401k contributions up to the employer match first, then contribute to a 529 plan. The key is to have a coordinated strategy.
That's a great point, Sam. It's about finding the sweet spot, right? Can you give us another example of a tax-advantaged strategy?
Absolutely. For retirement savings, families can utilize Roth IRAs. While contributions aren't tax-deductible, qualified distributions in retirement are tax-free. This can be especially advantageous if you anticipate being in a higher tax bracket in retirement.
So if I understand correctly, with a Roth IRA, I pay taxes now on the money I contribute, but I don't pay taxes later when I withdraw it in retirement.
Precisely. And that tax-free withdrawal can be a significant benefit down the line.
So, thinking about an advisor's role, how can they help weave all these different strategies together and personalize them for a specific family's needs?
An advisor can analyze your current financial situation, project your future income and tax liability, and then recommend a tailored strategy. This might involve a combination of 529 plans, Roth IRAs, tax loss harvesting within taxable accounts, and even strategically timing deductible expenses.
Tax loss harvesting. I've heard that term before, but I'm not entirely sure what it means.
Simply put, it's offsetting capital gains with capital losses to reduce your tax bill. Imagine you sold a stock for a profit, a capital gain. If you sell another investment at a loss, a capital loss, you can use that loss to offset the gain, reducing the amount you owe in taxes.
So, it's like strategically balancing gains and losses to minimize your overall tax burden.
Exactly. And this is just one example of how an advisor can proactively manage your taxes. They can also help you anticipate future tax implications of major life events, like buying a house or selling a business.
So, to wrap up this section on tax optimization for growing families, we learned about the power of tax-advantaged accounts like 529 plans and Roth IRAs, the concept of tax loss harvesting, and how a financial advisor can help weave these strategies into a personalized plan. They can also coordinate with other professionals like CPAs and attorneys, ensuring everyone is on the same page. This is especially important for larger financial decisions such as investments. The key is to be proactive, not reactive, when it comes to tax planning.
It's definitely more than just picking investments. It's a whole ecosystem.
Absolutely. Our call to action for our listeners today: research tax-advantaged accounts like 529 plans and Roth IRAs, and don't hesitate to seek professional advice to develop a tax-optimized investment strategy tailored to your unique family situation. As families grow and careers progress, so does the complexity of their financial situations. In our next segment, we'll be shifting our focus to those nearing retirement, the wealth optimizers, and exploring how to plan for retirement and those often daunting healthcare costs. Let's imagine someone in their early 50s starting to seriously consider retirement. They're likely thinking about when to retire, how much income they'll need, and how to cover potential healthcare expenses. This is where a good financial advisor can be invaluable. Taylor, as someone approaching this stage yourself, what are some of your initial thoughts on this?
Honestly, Alex, it feels a bit overwhelming. My parents are dealing with some unexpected medical bills, and it makes me realize how quickly those costs can add up. It makes planning for my own future healthcare even more important than I thought. So how does an advisor help someone optimize Social Security and other retirement income sources? That seems like a crucial piece of the puzzle.
It is indeed, Taylor. A good advisor will first help you project your retirement income needs, considering your lifestyle and desired spending. Then they'll look at all potential income sources: savings, investments, pensions, and of course, Social Security. Optimizing Social Security often involves strategically choosing when to start claiming benefits. Starting early means smaller monthly checks, but more of them. Delaying means larger checks, but you receive fewer overall. The advisor helps you analyze which strategy best fits your overall financial picture. They also help coordinate Social Security with withdrawals from other accounts to minimize taxes and maximize income.
So it's not a one-size-fits-all approach. This reminds me of what we discussed about diversification in our investment portfolio. Spreading your risk. It's like diversifying your income streams too.
Exactly. Now let's turn to the other big piece: healthcare. Sam, what factors go into estimating future healthcare costs, especially for long-term care?
Several factors play a role, Taylor. Age, family history of health issues, current health status, and even where you plan to retire can influence your costs. Inflation also significantly impacts healthcare expenses, which tend to rise faster than general inflation. A good advisor helps you estimate these costs based on realistic projections, considering potential long-term care needs, whether that's in-home care or assisted living.
So if I understand correctly, Sam, it's not just about having enough money saved for retirement. It's about ensuring that a portion of those savings is earmarked and strategically managed for potential healthcare costs.
Precisely. And that's where long-term care insurance comes into the picture. It can help offset some of the substantial costs associated with long-term care, protecting your other retirement assets.
This can all seem very complex, which is why having a qualified advisor to guide you through these decisions is so important. They can help you create a sustainable retirement income plan that accounts for both your desired lifestyle and potential healthcare needs. So, to recap, we've talked about optimizing Social Security benefits by strategically timing when you claim them and coordinating this with other income sources. We also discussed the importance of realistically estimating future healthcare costs, factoring in inflation and potential long-term care needs. If you're in this age range, I encourage you to evaluate your retirement goals and consider consulting with a financial advisor to create a comprehensive plan that addresses these crucial aspects of your financial future. Now, knowing how important a financial advisor can be during this stage of life, let's talk about how to choose the right advisor for you, someone who can truly guide you through these complex decisions. We'll explore the secured philosophy and professional standards in our next segment. Now we're focusing on a high net worth individual looking to create an estate plan that efficiently transfers wealth to their heirs while minimizing tax liabilities. This scenario covers so many important aspects of long-term financial health. Sam, Taylor, are you ready to dive in?
Absolutely, Alex. This is something I've been meaning to look into more seriously. It seems complicated, though.
It can be, Taylor, but breaking it down into manageable pieces makes it much less daunting.
Exactly. Let's start with the basics. What are the key considerations when developing an estate plan and choosing beneficiaries, Sam?
Well, the first step is identifying what assets you want to include in your estate. This could range from bank accounts and investments to property and personal belongings. Then you need to decide who your beneficiaries will be. These are the individuals or entities who will inherit your assets. You'll also need to consider what type of distribution you want: outright inheritance, a trust, or a combination. Tax implications are a huge consideration as well.
So if I understand correctly, it's not just about writing a will. There are different ways to transfer wealth.
Precisely. A will is a core component, but there are other tools like trusts that offer greater control and potential tax advantages. For example, a revocable living trust allows you to manage your assets during your lifetime and then seamlessly transfer them to your beneficiaries after your passing, often avoiding probate.
That's a good point, Sam. Probate can be a lengthy and costly process, something many people want to avoid. Can you elaborate on how a financial advisor helps navigate these complex strategies?
Absolutely. A financial advisor can help coordinate with estate planning attorneys to structure your estate plan efficiently. They can analyze your current financial situation, project future needs, and help minimize potential estate taxes. For example, they can help you understand the implications of gifting assets during your lifetime versus transferring them through your will.
This reminds me of what we discussed about tax optimization in the previous segment for the 35-44 age group. It sounds like those principles carry over, but become even more critical with larger estates.
You're absolutely right, Taylor. The strategies become more sophisticated, but the underlying principles remain the same. Minimize tax liabilities and maximize the amount transferred to your beneficiaries.
Sam, could you give us a practical example of how a financial advisor might coordinate with legal professionals in estate planning?
Certainly. Let's say a client wants to establish a charitable remainder trust. The financial advisor would work with the attorney to structure the trust in a way that maximizes the tax benefits for the client while also fulfilling their philanthropic goals. The advisor can also model different scenarios to show the client the long-term financial impact of various estate planning strategies.
So if I have significant assets, it's crucial to have both a financial advisor and an estate planning attorney working together.
Precisely. The attorney focuses on the legal documents and ensures everything is legally sound, while the financial advisor focuses on the financial implications and ensures the plan aligns with your overall financial goals.
So to recap, Estate planning isn't just about writing a will. It's a complex process involving asset identification, beneficiary selection, and choosing the right wealth transfer tools like trusts. Tax implications are a major factor, and a financial advisor plays a critical role in navigating these complexities and coordinating with legal professionals. If you're thinking about estate planning, and especially if you have significant assets, I highly recommend consulting with both a financial advisor and an estate planning attorney to create a plan that truly meets your needs and objectives. So, Taylor, we've talked about the importance of clear communication and effective technology use when choosing a financial advisor. But let's be honest, one of the biggest factors influencing our decisions, and often a source of confusion, is how much an advisor costs and whether they truly have our best interests at heart. This brings us to a crucial aspect of advisor selection: understanding their fee structure and fiduciary duty. Imagine you're considering working with an advisor, and you're trying to figure out how their fees work and how to ensure they're truly working for you. This is the situation we're diving into today. Sam, can you break down the various ways advisors charge for their services?
Sure, Alex. The most common fee structures are fee-based, commission-based, and fee-only. Fee-based advisors can charge both fees and commissions. Commission-based advisors earn money by selling you specific financial products like insurance or mutual funds. Fee-only advisors, however, only charge fees directly to you, their client. These fees can be structured as a percentage of assets under management, hourly rates, project fees, or retainers.
So, if I understand correctly, with a commission-based advisor, there's a potential conflict of interest, right? They might be incentivized to recommend products that earn them higher commissions, even if those aren't the best fit for me.
Exactly, Taylor. That's a key concern. But it's very important for us to understand that there is no fee structure that's truly 100% free from conflict of interest. This nuance needs more time for discussion than we have in this episode. Fee only feels like it removes that potential conflict, since the advisor's compensation is directly tied to your assets and the services provided to you, not the products they sell. But there's more to the story here.
That's a crucial point. Instead of jumping to conclusions like commission is always bad or fee only is always good, talk to the advisor how they put your best interest before yours. Now, Sam, let's talk about fiduciary duty. How can our listeners ensure their advisor is legally bound to act in their best interest?
The simplest way is to ask directly and discuss the details. If a financial planner is creating financial plan, then it's fiduciary. A true fiduciary advisor will readily confirm their commitment. You can also verify their registration and any disciplinary history with the SEC or your state securities regulator. As Alex mentioned in the introduction segment of our podcast episode, our secured principles emphasizes that a good advisor should empower their client, which is part of their fiduciary duty.
This reminds me of what we discussed about transparency. If an advisor is hesitant to discuss their fees or fiduciary status, that's a major red flag, right?
Absolutely. Transparency is key. A trustworthy advisor will be upfront about how they operate.
It's like choosing a doctor. You wouldn't hesitate to ask about their qualifications or treatment plan, would you? The same principle applies to financial advisors. So, to recap, understanding advisor fee structures, fee-based, commission-based, and fee-only, is essential for making informed choices. Equally important is confirming the advisor's fiduciary commitment. This ensures they're legally obligated to put your interests first. Before you entrust your financial future to anyone, thoroughly research and compare advisor fees. Don't be afraid to ask tough questions, and most importantly, confirm their fiduciary status. Your financial well-being depends on it. Taylor, imagine you're looking for an advisor. What communication features would be at the top of your list?
That's a great question, Alex. For me, clarity is king. I don't want to be bombarded with jargon I don't understand. I need someone who can explain complex financial concepts in plain English. Like if they're talking about stock options, they should explain it as if I've never heard of them before. Then build from there, simple to complex. Also, I really appreciate proactive communication. I want regular updates on my portfolio, not just when I ask for them. Thinking back to our discussion on the different life stages, I remember you mentioned how important this is for family and career builders. those juggling work, kids, and everything in between. They probably don't have time to chase down their advisor for updates.
Exactly, Taylor. Clear, jargon-free communication is fundamental. It builds trust and empowers clients to make informed decisions. A good advisor will adapt their communication style to your level of financial literacy. Think about it like a doctor explaining a diagnosis. They wouldn't use complex medical terminology with someone unfamiliar with the subject, right? They'd explain it clearly and answer any questions. The same principle applies to financial advice. Proactive communication through regular updates, clear reports, and easily accessible portals are also critical, especially in today's fast-paced world.
Sam, that's a perfect analogy. So, how can technology enhance this advisor client relationship and improve outcomes? The reference article we provided emphasizes utilizing modern technology while maintaining security.
Technology plays a huge role. Think secure client portals where you can access your financial information 24/7, video conferencing for face-to-face meetings regardless of location, and sophisticated planning software that can model different scenarios and help visualize long-term goals. A simple example would be a budgeting app linked to your accounts that provides real-time spending insights. More complex examples would be using algorithms to optimize investment portfolios or creating interactive retirement projections. However, all this tech advancement has to prioritize security, of course, to protect sensitive financial data.
So, if I understand correctly, technology isn't just about fancy gadgets. It's about making the entire financial planning process more efficient, transparent, and accessible. This reminds me of what we talked about earlier regarding the secured philosophy, the E for empowered. Technology can really empower clients to take control of their finances.
Absolutely, Taylor. It provides the tools and information for informed decision making. Let's recap. When assessing an advisor's communication style, look for clarity, proactive updates, and a willingness to explain things in a way you understand. As for technology, think about tools that enhance accessibility, transparency, and efficiency, all within a secure environment. Remember, choosing a financial advisor is a big decision. Take the time to evaluate their communication style and technology platform to ensure it aligns with your preferences and needs. Don't settle for anything less than clear, proactive communication and secure, efficient technology. And that wraps up our deep dive into finding the perfect financial advisor for your life stage. We explored the unique challenges and opportunities of the Foundation Builder, Family and Career Builder, and Wealth Optimizer stages, all based on that insightful guide, Finding Your Financial Advisor, a guide for different life stages. Just like we discussed in the beginning, aligning your advisor's expertise with your current needs is crucial. I think the discussions around navigating student loan debt while still investing and balancing college savings with retirement were particularly impactful. Remember, those secured principles, empower, master, balance, understand, adapt, and endure, are essential for choosing an advisor who truly puts you first. Thank you so much for joining me on Safe Simple Sound today. We appreciate you being part of the community. Be sure to check out the show notes for links and resources mentioned in this episode. Also, leave a review and share this episode with anyone you think might benefit. It might help someone find the financial guidance they need. Make sure you subscribe so you don't miss our future episodes. Until then, keep it safe, simple, and sound. This is Alex, signing off.